November 15th, 2023. We got a measured move up of the opening range here. And we also got a measured move down of basically this tight trading range, including tails. Which was about, it was, we didn't quite get to it, but I think that was one of the targets. Also, this close was probably a target. An interesting thing when you get a sell the close market like this is it was reasonable to sell that close. So those traders will probably have a chance to get out of break even. 60% chance we get back to this close, and 80% chance if they sell more below the next bear bar, it'll get to the midpoint or the next strong or reasonable bear bar closing near its low. You could argue that was bar two. You can see we got exactly to the midpoint of between two and that close, which I believe was bar 78 yesterday. Bar one was a bull bar closing on near its high, but not good enough and a bit disappointing for the bulls. So probably trading range price action, probably overall expecting a trading range day. Bar two, bad follow through for the bulls, which is to be expected, but it's not a very strong bear bar either, and it's not able to close on its low. So bad follow through for the bulls, bad follow through for the bears. Overall trading range open, most likely. Bar three, another bear bar, but a big tail on the bottom. So again, how much lower are we really going to go? Probably not much. Bears need much stronger closes. And this gap up in general was probably strong enough for another leg. You could argue it's the second leg from this, one pullback two. I don't know if they're the same height. Similar heights. Maybe if you use tails, it's the same. I don't look. What do you know? So this was leg one, and then we got a three push pullback, and then this was leg two up with the gap, and that's the measure move that we were touching right there. So one pullback two, and big tail on three and four. And what's really happening here is if you look, it's down, up, down, up, down, up. So on three and four. So you essentially get three attempts down, and all three get bought up, which is a wedge. So bar four is essentially a wedge on a lower time frame, and we try to get a breakout below said wedge on bar five, but it fails, and you get a big tail on the bottom of bar five. When you get a failed breakout below a wedge, you might try and get a move in the other direction, which is probably what six will be the start of. However, there's a big tail on six, and this channel is decently tight, so I don't think there's you don't really think you can buy above six. Some follow through on seven. But again, tail on top and disappointing. And eight is a big bull bar, but with the tail on six and seven, it could be a climactic third push up. Eight is probably an okay swing buy, but it's low probability, and it's kind of a tough call after bar nine because when you're taking something lower probability like this, and you get a doji bar as follow through, it's pretty hard to want to stay long. If you're taking a low probability trade like bar 46, you want to see quick follow through like we got on bar 47. 10 bull bar, but sellers at the new high. There's a lot wrong with this bull trend. It tells me that's probably not going to last, and we might get some sort of reversal. And by the time, and generally in trading ranges, one of the problems is by the time things become clear, like on bar 11, by the time it's clear, you get a pullback that's really tough to sit through, and a lot of times not really that smart to sit through. And that's what happened on bar 12. Is once we get this second leg up, it's probably just a second leg trap. And the doji bar on 9 is a problem. The tail on 10 is a problem. So probably going to end up being more sideways. And a lot of always in bulls are forced to exit below 12. Can you buy again above 13? I'm not really sure. It's doji bar, so it really doesn't seem all that great. And the bulls who bought the close of 11 seem disappointed enough in 12 that they're selling around break even during 14. 15, 16, good. They're bull bars, but there's big tails on the tops of them, and it's just really not right. And it seems like one pullback, two pullback, and this could be a third push up. So it's some sort of wedge open. Generally, when you get the 18 bar range and you fail to break out of the top of the 18 bar range, the market tries to break out to the other direction. And you can see here, we got a double top at the top of the 18 bar range, which means I thought it was pretty possible we were going to try and break out in the other direction. I think I have like one or two other examples of this here. Well, usually if it fails within 5 bars. So you can see here, we did break out to the top of the 18 bar range, but it failed within a couple of bars, and then we got a reversal down. Here, we got a failed breakout of the 18 bar range on bar 25 and a reversal down, and another failed breakout, and then we finally broke out to the upside. The where was I? Yeah, bar 18. So 17, it's a wedge top, but this is a pretty tight channel, so probably not all that great. Bad follow through bar 18. Bar 19 is a double top with 17, and 20 is a big bear bar, but a big tail on the bottom. Um, 21, I thought would have been a reasonable sell. It probably is a reasonable sell, but there are problems with it. If you're, bar 21, you want it to close outside down, and it's closing right on the moving average. So you pretty much needed it to close outside down, and it doesn't quite do that. And this channel is tight enough; it might get a second leg up. So the bears who are selling below 21 are hoping for fast follow through, and they just end up getting really bad follow through on 22, and that's really not what they were hoping for. Can you buy above 22? I think so. Your premise is that this is strong and it's going to get a second leg up, but we're overbought on the daily chart. We're just overbought in general. So it lowers the probability a little bit of 22 working. Additionally, you're kind of just you're buying the top of an overall trading range and you're buying kind of in the middle of a tighter trading range. So I'm not sure. I'm not sure it's awesome to buy above 22, but I think if you're trading always in, it's probably okay. Follow through for the Bulls on 23. Not all that great. And big tail on the bottom, which you don't love either, tells you that it could be, up on 21, down on 22, or sorry, that's up on 22, down on 22, and then up on 23, which is two legs. And so this could be a two-legged breakout pullback from the breakout of 21. So we might end up going down. 24, big tail on the bottom. If 24 closes strong, some bears will sell. Some bulls are disappointed enough that when they get the pullback on 24, they're exiting at the market, and that's what's causing basically the high of 25 to be the open of 25. But probably buyers below 24. You can see there were some buyers below 24. They were trying to force some sort of double bottom, but you can see they ended up getting kind of a pretty poor close on 25. So a lot of those traders just sell out at the market, and that causes a big bear bar on 26. 26 and 27 are follow through. These are probably sell to close bars on 26 and 27, hoping that we get a breakout of the 18 bar range and maybe we get back to this close. But, doesn't end up being as good as you want it to be. We did actually get back to this 45 close, by the way, just now. That's why there was a bounce right there. But these tails aren't as strong as, you want less tails than you're getting. So it's kind of disappointing. 28 inside bar, 29 inside bar, 30 inside bar. So we have an I pattern, 3 straight inside bars, basically just a triangle. You can see we end up getting a failed breakout to both sides and another failed breakout to both sides. So on 30, it failed below and it failed above. On 31, it failed above, or 32, it failed above. And then 33, I thought that was kind of the bear's chance to get some sort of bear close on 33 and then start to sell off. And they end up getting a doji close, which is really disappointing. Now we failed to break out, below this II a couple of times, so we might have to try onto the upside. 34, another doji bar. So we're in a 5-bar tight trading range. So you have to keep in mind, any breakout here is probably pretty limited because this tight trading range is going to be a magnet since it's trading range day. And so 35 is a big tail, and 36 is a good bull bar, but there are a lot of problems with it. You're buying at the top of an overall tight trading range, right? The overall tight trading range is this. So you're buying at the top of an overall tight trading range and you're buying right at the moving average. And the bar isn't as big as you'd want it to be. You kind of want it to be closing somewhere up here and it's not. And then when you do get a breakout above the tight trading range on 37, there's a big tail on the bottom, which makes you wonder, why was there so much selling here? Why were traders scalping out? If traders, were using this bar to scalp out of their longs, they're willing to buy back lower, but this tail tells you that traders are more interested in buying pullbacks than they are at buying highs and buying more higher. So again, more reasons why we might have to, get drawn back into this tight trading range. You still have to keep in mind at this point, 90% chance we're going to break out to the upside or the downside of the 18 bar range. So I think 36 is a low probability swing. I think 37 is a low probability swing. And when you get disappointing trading follow through on 38, a lot of traders will exit. And that's what's causing 39 is bulls, essentially giving up. Some will buy above 37, hoping we get big follow through, but you get disappointment on 38 and they flatten at the market and that causes 39. These are low probability trades, and when traders get bad follow through on low probability trades, they generally exit quickly because they know other traders will be exiting quickly as well. And these are when you get low probability trades like this that end up getting decent follow through. or when you get low probability trades that get good follow through, traders obviously are staying in because that's what they want. They want the fast, immediate follow through. And on trading range days, the saying is nothing is ever as good or as bad as it seems, which basically means, if it's trading range, these trades at the top of the trading range, like 22, or the trades, at the bottom of the trading range, like 29 or things like that are not as good as they seem. But even after this big bear spike, trades like 46 aren't as bad as they seem. They might have higher probability. It's a trading range, so it's likely we're going to get drawn back to the open, and you're at the bottom of a bear channel. So it increases the probability that we're going to get a move up. 40 and 41 was another II pattern, and we ended up getting essentially a breakout to the downside of the II. But you can see none of these bars are closing strong enough to make you want to sell the close of them. And by the time you get strong sell the close bar, like 44, guess what? You're basically about to reverse, which is pretty common in trading ranges, like things like bar 11. You finally get the bar you wanted, and then it starts to reverse. 44, you finally get the bar you want, and it starts to reverse. 46 or 45, bad follow through for the Bulls. Kind of bad follow through for the Bears. You do have an open gap here with this low, but it's probably going to end up getting filled since it's trading range day. And, as not great as it was, buying the close of 38 was kind of a reasonable thing to do after 4 straight bull bars. So I think those bulls might have to get out at break even. And that's additionally around the open of the day, which is always a magnet on trading range days, which is what this most likely is. So I think okay to buy about 46 for a swing. And you get good follow through on 47. Obviously, probability is much higher now. And then more follow through 48, 49. And it's pretty steep. And we're basically getting back up to the open of the day. And once we reach that magnet, essentially during 51, but around 50, we're pretty close. Once we start to reach those magnets, you can see the market enters a channel phase because traders are not as interested in buying because the market's more likely to go sideways here. And once you're at the channel phase, traders, they start to exit pretty quickly below bars like 56 or 57 when you get these micro double tops because it's a trading range day and the pullbacks can often be deeper than you want them to be. We essentially found buyers around 50% correction of the bull move. The market cycle is always spike, channel, trading range. So you could argue spike, channel, and then this formed the trading range. Generally, once you start to get a trading range around the open of the day, late in the trading range day, it's really not worth taking anything else. I think this is okay to sit out of. I thought that it was okay to buy above 59 for a second leg up. This is a strong spike, so I thought this was likely to get a second leg up, but you're not sure how far the second leg up is going to go. And once you get 60 and then kind of bad follow through on 61, 62, what's your premise? You could hold thinking this is going to get a second leg up, and you're probably right. The traders who bought below 62, you can see some of them were able to get out at break even during 67, but a lot of them got trapped. But in general, what I'm trying to say in general is that your premise of buying above here is that this is going to get a second leg, and your premise is a lot less valid once you're up here. So that's why a lot of traders start to be quick to exit with like a 5-point scalp, especially considering they had no true risk. So when you have no true risk on trading range days, traders tend to scalp more. And then you basically get a low one short at 67. That's not all that strong. You get follow through on 68, but it's probably going to end up having bad follow through as traders scalp out, seeing this as just a second leg for that. 69 is a bull bar. It's 2 legs down, and we might have to get back up here. But when you get bad follow through on 70, those traders sell out around break even during 71. Another reversal up on 72. You can see these trading range days like to just run, bad stops. If you sold below 12 and you had a stop above 12, your stop got ran, and then it went where you thought it was going to go. And they force always in traders out pretty quickly. These kinds of days before it goes your way. So you sell below 21, hoping you're going to break out, and then you kind of have to exit above 22, and then it goes your way. So, and even if, even down here, if you had your stop above the top of the tight trading range, hoping we were going to get a breakout to the downside, your stop gets run, and then it goes your way. So it's pretty common stuff, and you don't really want to trade in the tight trading ranges like here or anywhere in here. You really want to be trading, fading breakouts of the trading ranges like down here and things like that. So for always in, maybe you can buy above 8, but I just think it's like difficult to want to do that. maybe these are solid close bars. You can probably buy about 47, probably 59 or 60, but you have to be fast to get out because, a lot of problems when you're buying basically around the open of the day, late in a trading range day. It's probably going to be a magnet. Yeah, that was basically it. On the daily chart, kind of bad follow through for the bulls up here as expected. Probably going to get a couple legs sideways to down. Maybe a 3 or 4 day pullback. We'll see. I assume it's going to set up some sort of high one, which will probably lead to a high two. Yeah.